Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding Stocks, Basics and Key Definitions. Bull and Bear Markets. Bull markets and bear markets describe the general direction of the stock market. Bull market. When stock prices are rising or expected to rise. It's a time of optimism. Investors expect strong economic performance. Bear market. When stock prices are falling or expected to fall. It's a time of pessimism. Investors might be worried about the economy. These terms are crucial because they reflect investor sentiment and have a significant impact on stock prices. Think of bullish investors as the bulls charging ahead, while bearish investors are like bears retreating. By understanding these terms, you can better navigate the stock market and make informed decisions. Why invest in stocks? Investing in stocks can seem daunting, but the potential benefits make it an appealing option for many. Whether you are saving for retirement, a future home, or simply to increase your wealth, stocks can play a crucial role. Let's break down why you might consider adding stocks to your investment portfolio. Potential for growth. When you invest in stocks, you buy a piece of a company. If the company grows and becomes more profitable, the value of your stock can rise, leading to capital appreciation. Here are a few reasons why stocks have such potential for growth. Innovation and expansion. Companies often innovate new products or expand into new markets. This can lead to increased revenues and higher stock prices. Long-term performance. Historically, stocks have outperformed other investments like bonds or savings accounts over the long term. Market demand. As more people invest in a company, the demand for its stock rises, which can push the price up. Think of investing in stocks like planting a tree. It grows slowly but can become massive over time, providing shade and fruit for years to come. Income generation. Stocks aren't just about growth. They can also provide regular income through dividends. Dividends are payments made by a company to its shareholders, usually from profits. Quarterly payouts. Many companies pay dividends quarterly, offering a steady stream of income. Reinvestment. You can reinvest dividends to buy more shares, compounding your returns. Dependable income. Well-established companies often provide reliable dividend payments, making them attractive for income-focused investors. Imagine getting a small bonus every few months just for holding on to your stocks. Diversification. Diversification is a key strategy in reducing risk in your investment portfolio. Investing in stocks allows you to spread your money across different sectors and companies, which can help balance risks and rewards. Different sectors. By owning stocks in various industries, you reduce the risk of a single sector downturn affecting your entire portfolio. Global opportunities. You can invest in international stocks, gaining exposure to growing markets around the world. Asset mix. Combining stocks with other asset classes like bonds or real estate can help improve the stability of your portfolio. Think of diversification like a balanced diet. Just as you wouldn't eat only one type of food, you shouldn't invest all your money in one type of asset. In summary, investing in stocks offers the potential for growth, income generation, and diversification. These factors make stocks an attractive option for building a robust and dynamic investment portfolio. Risks of investing in stocks. Investing in stocks can be rewarding, but it has its share of risks. Understanding these risks helps you make better decisions and manage your investments wisely. Let's break down the main risks you might face when investing in stocks. Market risk. Market risk is the possibility of losing money due to changes in the overall market. This can be caused by economic downturns, political events, or natural disasters. Volatility. Stock prices are like roller coasters. They can go up and down pretty quickly. This is known as volatility. When prices spike or drop, it can make you nervous and lead you to make rash decisions, like selling too soon or buying at the wrong time. Company-specific risk. Company-specific risk. Not all risk comes from the market. Each company has its own set of risks. These are tied to how the company performs, decisions made by its management, and even industry trends. Factors to consider. Business performance. If the company isn't meeting its targets, its stock price can drop. Management decisions. Poor leadership can negatively impact a company's future. Scandals or legal issues. These can lead to significant financial losses. Understanding these risks can help you better navigate the stock market. Remember, always do your research and never invest more than you can afford to lose. By being aware of these risks, you're one step closer to making smarter investment choices. Understanding stocks lays the foundation for smart investing. Key points such as what stocks are, types of stocks, and how the stock market functions are essential. Knowing these basics helps you make informed decisions and can lead to greater financial success. Investing in stocks can be rewarding, but it's crucial to grasp the basics first. Familiarize yourself with terms and concepts to build confidence. The more you learn, the better your investment choices will be. Keep exploring and educating yourself about stocks and the market. The journey of investing is ongoing, and continuous learning is key. Understanding stocks is essential for anyone looking to venture into the world of investing. Stocks, often referred to as shares or equities, represent a unit of ownership in a company. By purchasing stock, you are essentially buying a small piece of that company, which entitles you to a share of its profits and potentially gives you voting rights in company decisions. Here's a detailed look at the basics of stocks and some key definitions that every investor should know. At the core of stock investing is the concept of equity. Equity refers to the value of an ownership interest in a company. When you buy a stock, you become a part owner of that company, and your equity stake represents your portion of the company's total value. Companies issue stocks to raise capital for various reasons, including expanding operations, developing new products, or paying off debt. There are two main types of stocks: common stocks and preferred stocks. Common stocks are the most typical form of equity ownership. They give shareholders voting rights, usually one vote per share, which allows them to participate in corporate decision-making processes such as electing the board of directors. Common stockholders also receive dividends, though these are not guaranteed and can fluctuate based on the company's profitability. Preferred stocks differ in that they generally do not come with voting rights. However, they have a fixed dividend, which can provide more stable income. In the event of a company's liquidation, preferred shareholders have a higher claim on assets than common shareholders, but they still rank below debt holders. Understanding stock exchanges is also essential. Stocks are bought and sold on stock exchanges, which are marketplaces for securities. Major stock exchanges include the New York Stock Exchange, NYSE, and the NASDAQ. Transactions on these exchanges can be conducted electronically or through floor trading. Brokers act as intermediaries, facilitating these transactions between buyers and sellers. A critical concept in stock investing is market capitalization, often referred to as market cap. Market cap is the total market value of a company's outstanding shares of stock. It is calculated by multiplying the current share price by the total number of outstanding shares. Market cap is used to categorize companies into different sizes: large cap, mid cap, and small cap, each with its own risk and return characteristics. The price-to-earnings ratio, P/E ratio, is another vital metric. The P/E ratio measures a company's current share price relative to its earnings per share, EPS. A high P/E ratio may indicate that the stock is overvalued, or it could suggest that investors expect high future growth. Conversely, a low P/E ratio might indicate that the stock is undervalued or that the company is experiencing challenges. Dividend yield is an important consideration for income-focused investors. It represents the annual dividend payment divided by the current stock price. This ratio helps investors understand how much return they are getting from dividends relative to the stock's price, providing insight into the income-generating potential of an investment. Another key metric is earnings per share, EPS, which indicates a company's profitability. EPS is calculated by dividing the company's net income by the number of outstanding shares. A higher EPS indicates better profitability, making it a crucial measure for evaluating a company's financial health. Beta is a measure of a stock's volatility compared to the overall market. A beta greater than 1 indicates that the stock is more volatile than the market, while a beta less than 1 suggests it is less volatile. Understanding beta helps investors gauge the risk associated with a particular stock relative to market movements. Book value per share is another important concept. It represents the net value of a company's assets divided by its outstanding shares. Book value is often compared to the stock's market price to determine if a stock is overvalued or undervalued. The bid and ask prices are fundamental to stock trading. The bid price is the highest price a buyer is willing to pay for a stock, while the ask price is the lowest price a seller is willing to accept. The difference between these prices is called the spread. A narrow spread typically indicates high liquidity, while a wide spread may suggest lower liquidity and higher volatility. Stock splits and reverse stock splits are actions companies take to adjust their share prices. In a stock split, a company increases the number of its shares, reducing the price per share but not changing the overall market cap. This can make the stock more affordable and attractive to investors. In a reverse stock split, a company decreases the number of shares, increasing the price per share, often to meet minimum price requirements for stock exchanges. In conclusion, understanding stocks involves grasping key concepts such as equity, types of stocks, market capitalization, P/E ratio, dividend yield, EPS, beta, book value, bid and ask prices, and stock splits. By mastering these basics, investors can make more informed decisions, build diversified portfolios, and work towards their financial goals with greater confidence and clarity. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.